In the year 2000, Enron Corporation was named America's Most Innovative Company by Fortune magazine. For the 6th consecutive year, its stock was trading at $90 a share. Its annual revenue was reported at $111 billion. Its executives were celebrated on magazine covers, invited to the White House, and held up as the model of what modern American business could achieve. 14 months later, the company did not exist. 20,000 employees lost their jobs overnight. Billions in retirement savings, money ordinary workers had spent careers accumulating, vanished completely. And the men who had built the fraud walked away with hundreds of millions of dollars they had quietly extracted before anyone knew what was happening. Most people know Enron as a story about greed, about a few corrupt executives who cooked the books until it all fell apart. That is not what Enron was. Today on Wealth Map, we are mapping the Enron scandal, not the simplified version, but the architectural version, the specific mechanisms that made it work, the specific failures that allowed it to continue, and the specific lesson that the financial system buried as quickly as possible because it was too uncomfortable to leave visible. Here is the thing that makes Enron genuinely remarkable as a case study. The core accounting trick that powered the entire fraud was not illegal. Enron lobbied the United States Securities and Exchange Commission in 1992 to be allowed to use something called mark-to-market accounting for its energy trading business. The SEC approved the request. Here is what mark-to-market accounting allowed Enron to do. When Enron signed a long-term energy contract, say a 20-year deal to supply natural gas to a utility company, it was allowed to immediately book the entire estimated profit of that contract as current revenue. Not when the revenue was earned, not when the gas was delivered. Immediately, on the day the contract was signed, the estimated profit, estimated by Enron itself, using assumptions about future energy prices that nobody could verify and nobody was seriously checking. In a single accounting decision, Enron had given itself the ability to manufacture reported profits out of projected future cash flows that may never materialize and book them today as if the money was already in the bank. When those contracts underperformed, as many inevitably did, the losses were quietly moved into hundreds of separate legal entities called special purpose vehicles, off-balance sheet structures designed specifically to hide debt and losses from anyone reading the company's financial statements. The profits were visible, the losses were invisible, the stock price climbed, the executives collected their bonuses, and the whole structure required only one thing to keep functioning. Everyone with the authority to question it had to choose not to. This is where the Enron story becomes genuinely disturbing, because the people who should have caught it did not fail through incompetence. They failed through incentive. Arthur Andersen was one of the 5 most prestigious accounting firms in the world. They were Enron's auditor, the independent party whose entire purpose was to verify that Enron's financial statements were accurate. In the year 2000, Arthur Andersen earned $25 million in audit fees from Enron. They earned an additional $27 million in consulting fees from the same company, an auditor being paid $52 million a year by the company it is supposed to be independently scrutinizing is not an auditor. It is a business partner with a very strong financial incentive to not look too carefully at what it is approving. Arthur Andersen knew internally their own partners raised serious concerns about Enron's accounting practices as early as 1999. Those concerns were documented, discussed, and ultimately set aside. The Wall Street analysts covering Enron were employed by investment banks that were earning millions in fees from Enron's deal-making. Of the 17 analysts covering the stock in August 2001, just months before the collapse, 16 had a buy recommendation on it. The journalists who should have investigated it were fed a steady stream of access, exclusives, and carefully managed information by one of the most sophisticated corporate communications operations in American business. The system designed to catch fraud had been quietly captured by the same incentive structure that made the fraud profitable. In October 2001, Enron restated its earnings, acknowledging that it had overstated profits by nearly $600 million over for years. The stock began to fall. What happened in the weeks that followed revealed the final and most damning layer of the scandal. As the stock collapsed from $90 towards zero, Enron's senior executives, who had known for months that the company was insolvent, were quietly selling their shares in large volumes. Kinley, Enron's CEO, sold over $70 million worth of stock in the period leading up to the collapse. Jeff Skilling, his predecessor, had sold over $60 million worth before resigning in August 2001, claiming personal reasons. Meanwhile, Enron's employees, whose retirement savings were held almost entirely in Enron stock through the company's pension plan, were locked out of selling their shares during a critical administrative transition period. While executives liquidated their positions, ordinary employees watched their life savings go to zero and could do nothing about it. When the bankruptcy was filed in December 2001, it was the largest in American history at the time. Kinlay was convicted of fraud and conspiracy into 2006, but died before sentencing. Jeff Skilling served 12 years in prison. Arthur Andersen ceased to exist as a firm within months of the scandal becoming public, but the structural conditions that made Enron possible, auditors paid by the companies they audit, analysts employed by banks with financial relationships with the companies they cover, off-balance sheet accounting structures, remain largely intact long after the headlines moved on. The lesson of Enron is not that some executives are dishonest. The lesson is that when an entire system of oversight is structured around incentives that reward looking away, people look away intelligently, deliberately, with full awareness of what they are choosing not to see. This is not unique to Enron. It is not unique to 2001. The same incentive structure that allowed Enron to operate for years in plain sight is present in financial systems around the world today in different forms. Understanding it does not make you cynical. It makes you precise, because the investors, the employees, and the ordinary people who lost everything in Enron's collapse were not stupid. They were simply operating without the map. This is Wealth Map. We draw the map. Subscribe, because the next video reveals how the people who build these systems protect themselves from them, and what that means for everyone else.